Good day and welcome to your next F6 Express recording. Our next chapter is capital gains tax. And capital gains tax is a tax that is imposed on the capital gains that an individual or a company makes in respect of an asset that has been disposed of or deemed to be disposed of during the year of assessment. CGT affects people who are resident and those who are partially resident in the country. The capital gain equals the amount by which the proceeds in consequence of the disposal of the asset exceed the base cost. The capital gain is completely different to the taxable capital gain, because the taxable capital gain is for individuals 25% of the capital gain, and for corporate entities 50% of the capital gain. The basic framework of capital gains tax: you will have your gross income less exempt income, which gives you income. You have deductions and set-offs, and then you will add all amounts to be included in taxable income in terms of Section 26A of the Income Tax Act 58 of 1962. You will have your capital gains for the year less any capital losses for the year. For natural persons and special trusts, you get an annual exclusion of 20,000 Rand. You will then get an aggregate capital gain from where you can deduct any assessed losses from a previous year. You get a net capital gain, and from that net capital gain, if it's an individual, it will be 25% of that will be your taxable capital gain, which is added to your income to give you taxable income. Your annual exclusion on death is 200,000 Rand. Rates at which net capital gains are included, which we have done. Asset defined. You need to define an asset. What is a capital asset? It is anything that is movable or immovable, corporeal or incorporeal, excluding any currency but including any coin made mainly from gold or platinum, and a right or interest of a nature in any property. It excludes 20,000 Rand per annum for natural persons and trusts, 200,000 where a person dies in that year, and if you have a primary resident occupied by an owner, you have an exclusion of up to 2 million Rand gross rule or 1.5 million Rand gain rule. The other things that are excluded are personal use assets, lump sum retirement benefits, long-term insurance, disposal by creditor of debt owed by a connected person, disposal of small business assets where the gross value of the business must not exceed 5 million Rand. Only natural persons in sole partnerships, in sole proprietorships, partnerships and companies where the interest is less than 10%, must have been owned for at least 5 years prior to disposal. The individual must have attained the age of 55, and the disposal must be due to ill health, infirmity or death, and the total amount of capital gain must not exceed 900,000 Rand during the person's lifetime. Disposal of micro business assets, exercise of options, compensation for personal injury, illness or defamation. Remember, this only applies to natural persons or special trusts. Prize money, as long as the individual is not a professional gambler. If the person is a professional gambler, the prize money would form part of his gross income, as it would be of a revenue in nature. Collective investment schemes in securities, public benefit organizations and other exempt bodies, exempt persons, capital gains or losses of a public benefit organization, assets used to produce exempt income, land restitution, and disposal of equity shares in foreign companies. Asset disposal, they go on to define the word disposal, which is an event, act, forbearance, or operation of law that results in the creation, variation, transfer, or extinction of an asset. Part disposals, if you make a part disposal, your base cost is apportioned to the market value of that part disposal. A deemed disposal. Remember, we love the word deemed in income tax. So we will deem a disposal even though there has not been an actual disposal in the following circumstances: where an individual ceases to be a resident, or where a company ceases to be a controlled foreign company, where there is change in status of a non-resident's assets, where a person becomes a resident, where a capital asset becomes trading stock, and vice versa, where trading stock becomes a capital asset, where there is change of use of personal use assets, transfer of an assets between funds of a long-term insurer, or the reduction or discharge of a debt. Time of disposal. Specific times of disposal where you would bring in the capital gain. If it's a donation, it's a date of compliance with all legal requirements. If it is an expropriated asset, it's the date when full compensation is received for the asset. Conversion of assets, the date of conversion. Options, the date on which the option is granted, renewed, or extended. Forfeiture of assets, date of extinction of the asset. Scrapping, loss, or destruction when full compensation is received. Vesting of trust assets, the date on which the asset vests. Distribution of asset to a shareholder, the date on which it is actually distributed. Value shifting agreements, date on which the value of the interest decreases. Deemed disposals, date immediately before the date on which the relevant event occurs, and partner's interest when it is disposed of. In a deceased estate, the deceased is deemed to have disposed of the assets to the estate on death for proceeds equal to the market value of those assets as at the date of death, excluding assets transferred to spouses. Proceeds. What is it that we call proceeds? It is an amount in respect of the receipt or accrual which must be causally related to the disposal of the asset, received by or accrued to, or deemed to have been received by or accrued to in the case of a deemed disposal, and in consequence of that disposal. Disposals to a connected person. Where disposal to a connected person occurs, the person who disposed of that asset is deemed to have done so for proceeds equal to the market value at the date of disposal. Any capital loss arising from a disposal to a connected person must be disregarded. Capital loss. A capital loss is where your proceeds are less than your base cost. If you have a capital loss, it is ring-fenced. By that we mean it can only be deducted from capital gains in that year or any subsequent year, as capital losses can be carried forward. What is base cost? Base cost is the sum of the expenditure incurred when the asset was acquired or created, plus expenditure incurred subsequent to that relating to the asset. The base cost is reduced by amounts allowed as deductions for income tax purposes. So if you did get an allowance on that asset, that will serve to reduce the base cost of the asset. Any asset acquired after the 1st of October 2001, that date is important because that is the date that capital gains tax was implemented in this country. You could use one of the following valuation methods. The first one is the market value of the asset on the 1st of October 2001. If you don't have that, example shares, there is a share register of what shares were valued at on that date. 20% of the proceeds of the disposal of the asset. That is a little bit stupid, because if you dispose of an asset for 100 Rand, they're trying to tell you that you must use a formula where your base cost is 20 Rand of the 100 Rand, and your capital gain will therefore be 80 Rand. And then the last one is the time apportionment base cost method, which we will deal with now. The formula is y is equal to b plus p minus b multiplied by n over t plus n, where b is expenditure before the 1st of October, p is the proceeds on disposal, n the number of years determined from the date that the asset was acquired to the end of September 2001. Please remember that part of a year is treated as a whole year. So you will not have a year and a quarter and a year and 2/3 and all that. And T is the number of years from the 1st of October until the asset was actually disposed of. Where there were costs incurred on the asset on or after the 1st of October 2001, you will use an adjustment formula to work out the proceeds. And this P will be substituted in this first formula, in the basic formula. So your adjustment formula would read P is equal to R multiplied by B over A plus B, where P is the proceeds to be used in the previous formula. R is the total proceeds in terms of paragraph 35. A is the expenditure allowable in terms of paragraph 20 incurred on or after the 1st of October 2001. And B is any expenditure that was incurred before the 1st of October 2001. And that is the last of capital gains tax. We will see you at the next recording. Thank you. Bye.